ETFs, or exchange traded funds, are one of the most popular and easiest way to invest in the financial markets. But here is the problem. Many people invest in them blindly. They have probably seen or heard someone online recommend a particular ETF, and just like that, they click buy without realizing that there are hidden details that could make or break their financial investments or experience with ETFs. So, if you are considering investing in the financial markets with ETFs, here are 5 important things you need to look out for before buying or choosing an ETF. These checks would help you invest confidently and avoid costly mistakes. And the good part is all the information I'll be sharing is available online, and I'll be showing you exactly where to find them at the end of this video. So let's get started. What is an ETF? An ETF is an investment fund that holds multiple underlying assets inside a convenient product. Rather than buying multiple hundreds, thousands of individual stocks, you can own a fraction of each in just one ETF. What things should I be looking out for before buying an ETF? The first thing to look out for will be the ETF's market or region. Are you aware that most of these global ETFs invest about 70 to 72% in American companies? If you're investing in these ETFs with the impression that you're actually diversifying across regions or markets, that might not actually be true. According to a recent report by Fidelity, the MSCI World Index actually invests about 72% in US stocks and 28% in the rest of the world combined. If you are investing in ETFs, you want to decide which region or market do I want to be exposed to. The region or market that you get exposed to will be dependent on so many factors that you want to decide by yourself. If you want exposure into the US market, you probably want to look into ETFs that track the S&P 500 or NASDAQ. If your focus is exposure in the Europe stock market, then you want to look into ETFs that track the Stocks Europe 600. If you want ETFs in the UK, then you might want to consider ETFs that track the FTSE 100. And if your interest is in emerging markets, then you might consider the MSCI Emerging Markets Index. ETFs tracking that will be beneficial for anyone interested in emerging markets. I don't want you to just be out there going with the word or the phrase global and thinking that once it says global, then automatically I am investing in all the regions across the world. You really want to be asking the question, where is my money being exposed to? The second thing you want to look out for before buying an ETF is the dividend. And that's a personal favorite, I know, for many of us. So ETFs or investments would promise you a very high yield. Take, for instance, the Invesco KBW Premium Yield REIT ETF. That's a long one. Currently gives a yield of around 9%. And that might also appear as a little bit risky. Many times, a lot of companies do this because with that promise of a high yield, they can attract a lot of investors. Sometimes down the line, they end up giving cuts because they cannot, keep up with that promise. Another thing to be aware of when you are thinking about dividends as it concerns ETFs is this a distributing ETF or an accumulating ETF? A distributing ETF will pay dividends to you in form of, cash payment, while an accumulating one will reinvest automatically your dividends into your portfolio to help you grow your portfolio. This is important because it depends on how you're investing. You might want to ask or look at if you're investing through a normal brokerage account or if you're using a tax efficient account, as this can impact your tax considerations. As well as you may also want to look at your income preferences. Do I want to keep my dividends or do I want to reinvest my dividends? So these are questions or things to look out for when you're choosing an ETF based on your dividend preference. Thirdly, the third thing you want to look out for before you buy buy an ETF is the asset manager. The asset manager are the professionals in charge of managing the ETF funds, right? You might want to wonder, why are they important? Well, the asset manager is responsible for managing the investments, executing the strategy, as well as mitigating risk. It is not just a name on paper, and not all asset managers are created equally. For example, if you are investing in an active ETF where the asset manager is responsible for actively picking and choosing all of the underlying assets, you want to be more interested in who your asset manager is, as opposed to if you were just overseeing or tracking an index as in passive management. This would interest you because even though we have over 4,000 ETFs globally, the market is highly concentrated, with the top 3 managers being in charge of about 74.3% of all the equity ETF markets. You really want to ask, who is in charge of this ETF? What is their experience and what is the performance of that ETF? Like I mentioned earlier, it is not just a name on paper. You really want to be sure that whoever is handling your money has the right expertise to do so. Now, the fourth thing you want to look out for is the fees associated, or the TER. The TER stands for the total expense ratio, which is the annual percentage that would be charged on your investment and given to the fund manager for managing your funds on your behalf. It usually covers fees like management fees, administrative fees, auditing fees, and some custodial fees. The TER has historically been a good gauge of the drag on your investment. So knowing the TER, how much you're paying on these investments, can help you look into how much would actually be left in your investment, because you would be paying some money out. So take, for instance, if you invest $10,000 and the TER, or the expense ratio, is about 0.04%, you will be paying your fund manager $4 annually just for the entire year for managing your funds. In 2024, the average equity ETF had a TER of 0.4% and bonds had about 0.2%. So for anyone that invested about $10,000 last year in 2024, they eventually paid about $40 to their fund manager. A lower TER is helpful because you get to keep more money and you have more money left in your portfolio. The fifth thing you want to look out for before buying an ETF is the size. Size definitely correlates positively with stability. You see, larger ETFs enjoy something called economies of scale, which means that they have a tighter way or spread of their money, and they enjoy lower cost when it comes to stocks and, some of the investments that they put your money into. And for that reason, if you have that type of economy of scale, the fund manager might consider some flexibility as to potentially reducing the expense ratio, improving even the longevity of that particular investment or fund. It's also helpful because it helps you cushion the effect of sudden collapse of that ETF, because you know that it's such a large one and the chances that it would fall off would be very, very low. Size definitely does matter, but size is not the only yardstick for performance. Now that we have talked about our top 5 things to look out for before buying an ETF, here are some extras that I want you to also pay attention to. First is the benchmark. What is ETF being compared to? Like, is it trying to beat or match the benchmark? What index is it trying to beat or match? You want to ask yourself this because you want to know, is it performing better than the benchmark or is it underperforming significantly? Next is the UCITS status. That is something that was introduced in Europe, and it helps you to add an additional layer of protection to your investment, and you want to be aware of that as well. Another one is it a leveraged ETF? So these are the ones that invest in specialty areas or industries like technology, energy, or even special commodities or products like gold. They are usually riskier, but you also have a higher potential of more gains if it goes very, very well. Another thing you want to consider is the structure of the ETF. Is it a physical ETF or a synthetic ETF? So physical ETFs means that you own the underlying assets, while synthetic ones mean that you just oversee or track track the underlying assets. Lastly, something you want to consider is hedging. Hedging is a type of investing with the intention of preventing losses, and it can be helpful if you're investing internationally, especially to protect you against FX changes. With that, we've come to the end of the top things that you want to look out for before investing in ETFs. Now, where can you find all of these information? Well, you can look at your broker's ETF page. You can look at ETF providers' websites like Invesco.com, Vanguard.com, as well as you can look at the ETF's prospectus or the ETF's fact sheet. In a matter of seconds, you will be able to find all of this information as it relates to the size, the dividends, its markets of region, the structure, benchmark, what the asset manager is, and that will help you to make informed decisions. We have now come to the end of this video. I hope you liked it and I hope it was helpful. If you like this video, please give it a thumbs up and subscribe to this video to continue getting helpful and relatable contents like this. See you again. Bye.
The Lord bless you and keep you. The Lord make his face shine on you and be gracious to you. The Lord turn his face toward you and give you peace. Numbers 6:24-26.